Hello guys, welcome to the third video on concept of valuation. In the first video, we have discussed on the introduction to the concept of valuation and also discussed the compounding concept of valuation of money. If you remember, we have discussed via an example how future value differs when interest is paid yearly, half yearly and even quarterly. In the second video, we have discussed about the future value of a series of cash flow. Means to say, when there are multiple investment done either at the beginning of the year or at the end of the year, and we try to calculate the future value. Today what we are going to discuss with reference to the valuation concepts only. The concept is compound sum of annuity. ANNUITY, compound sum of annuity. Now what it means? An annuity is a series of payment or receipt of fixed amount, or else it's a stream of equal cash flows. What it means? If you take into example something like the LIC, Life Insurance Corporation, the premium which we pay a fixed amount as a premium. We pay EMI for a home loan which is also fixed in nature. Every month maybe the same amount is getting debited from the bank account. So annuity refers that when the amount is fixed in nature, that means the same amount is paid. Like in case of this example, we are talking from the point of view of investment, the same amount is invested over and again. Now what is the formula which we used last time, if you remember? Say let's take an example. So the invested amount, the investment is rupees 2000 every year. The investment as mentioned is rupees 2000 every year, and we have been investing this at the end. Let's take an example. Investing it at the end of every year. The interest given is at the rate of 5%, and the time period is for 5 years. So this is the information which has been given. Now, in case of a series of cash flow, we are aware of that we did a formula where the future value was equal to P1 bracket 1 plus I to the power n plus P2 bracket 1 plus I to the power n minus 1 plus P3 bracket 1 plus I to the power n minus 2. This we have done last time. Plus P4 bracket 1 plus I to the power n minus 3 plus P5 bracket 1 plus I to the power n minus 4. Now please understand, annuity means that the series of payment or the receipt is fixed in nature. And we have taken an example of 2000. What to mean means that first year I have paid 2000, second year I am also paying 2000, third year I am also paying 2000. So I'll write it somewhere here. First year I paid 2000. Second year I again paid 2000. Third year I again paid 2000. Fourth year I paid 2000. Fifth year I paid. Then I say this as an example of an annuity. If my P1, P2, P3, P4 and P5 is rupees 2000, can I write or P1 is equal to P2 is equal to P3 equal to P4 equals to P5, and I consider it only as P. So what I do, I take common P. The principle is same. So what I do, I take P into consideration. So what I did, P bracket 1 plus I to the power n plus 1 plus I to the power n minus 1 plus 1 plus I to the power n minus 2 plus 1 plus I to the power n minus 3 plus 1 plus I to the power n minus 4. Now we use this particular information into consideration to calculate. So what is P? P is rupees 2000, which is fixed. Now we could to calculate this. 1 plus I to the power I is how much? Interest, which is 5%, and your time period is, now I said this all at the end of the year. If you remember, at the start we said at the end of the year. Now if it is at the end of the year, that means to say if it is at the end of the year, now please understand this particular concept. If we mention this as at the end of the year, so if this is the investment, this is 5, 4, 3, 2 and 1. At the end of the year means here, beginning of the second year. So how much time we are getting? 1, 2, 3, and we are getting it matured in the 6th year. So 1, 2, 3, 4. So if you are investing at the end of the first year, basically I am getting 1, 2, 3, 4 time period for investment. So it will not be 5, it will be 4, because you are doing it at the end of the year. So what we do? So n here will be 4. So we try to calculate 1 plus I to the power n. So bracket 1.05, because my interest is 5%, so it's 0.05. So I put a bracket, power, and n will be 4. Why it's 4? Because at the end of the first year you are investing 1, 2, 3, 4. You are getting 4 times. So to the power 4. To the power 4 gives 1 point. Say I'm taking 2 decimal into consideration. Can I take 1.22? It's 215. Since it's 5, I have taken 22. So next one is n minus 1. So n minus 1 will be 3. 4 minus 1 will be 3. So it's coming 1.16. 157. I've taken 16. The next is coming minus 2. So n minus 2, that is 4 minus 2, so it's to the power 2, it's coming plus 1.10 plus n minus 3, 4 minus 3 to the power 1 is 1.05, and to the power 0 is 1. So this is what we get. 2000 into 1.22. So if I add up all this, so I'll just show you. If I add up all this, that means 1.22. So I cancel this. 1.22 plus 1.16 plus 1.16 plus 1.10 plus 1.10 plus 1.05 plus 1.05 and plus 1 gives me 5.53. So I'm basically getting, this part is 5.53. So I had what? I had 2000 multiplied by this all. So I got this all, I got how much? 5.53. So it will be 2000 into 5.53. Since I don't have a space out here, just show you here. So it's coming 2000 into 5.53, which is equal to, so if I take this into consideration, equal to 5.53 into 2000, it's 11,060 will be my future value. So I was basically calculating future value. I was trying to calculate future value. So future value is coming 11,060. Now this is how we have solved this. We have solved using the mathematical calculation, the mathematical calculation formula. So we have got 11,060. So this is what the answer is with reference to the calculation of future value. Now we also require to understand that if we have to solve this particular problem, with reference to a tabular format, then how we do. So let's talk about that. If we are doing the problem in a tabular format, then how it happens. Again, we use the same concept. It's at the end of the year. the investment is done. So what we got? So you are aware of the number of columns which we have. So first column is year. Then we have amount you have deposited. So amount deposited. Next we got number of years compounding. This is the most important part. That is the reason why I said at the start of the year or else is at the end of the year. So next comes is the compounding factor. This table which we already have done in the last video. And last come is future value. So this is what we require to calculate. Now I have shown you the mathematical formula. I am also showing you the tabular format. Whichever is convenient, you can refer to that. So 1, 2, 3, 4, 5, and as I know that we are doing an annuity, so the investment amount remains the same. So I have deposited rupees 2000 every year. I have given to this investment company. Now if you remember, I said at the end of the year, this is at the end of the year, if you remember. So at the end of the year means the beginning of the second year. So 1, 2, 3, 4 years, if you remember, we calculated. So 4, 3, 2, 1 and 0 is the number of years of compounding. Now we also require to find out the compounding factor using the formula. So we use the compounding. So how the formula is 1 plus I to the power n. So we use a bracket, because why I'm using the bracket? I'm using the bracket because there is a power. So 1.05 to the power, first one is for 4 years, so for 4. So it's coming 1.21. I'll keep it here. So it's coming 1.215. So let's see. Let me take 3 decimal here. 215. So the next one is coming to the power 3. It's coming 1.157 to the power 2. It's coming 1.102 to the power 1. It's coming 1.05, and you are aware of to the power 0 will always be equal to 1. So I have got this. Now what I do? I find out the future value. Now you are aware of how to calculate a future value. How we calculate a future value? It will be amount deposited multiplied by your discounting, the compounding factor. So I got 2000 into 1.215. So 2000 into 1.215 is 2430. Next, how much? Again 2000 into, because it's an annuity, 1.157. So I just change it. 1.157. It's 2314. Next one is 1.102. It's coming 2204. Remember, I've taken 3 decimal. Next is 1.05. It's coming 2100. And 2000 into 1 will be 2000. So if I add up, I'll get the future value. I'll get the amount of future value. So how much is coming? So I add up 2430 plus 2314 plus 2204 plus 2100 plus 2000. It's coming 11,048. It's almost same. The mathematical formula and the tabular formula will almost be very, very close. It will not be. It may not be the same answer. May not come the same answer. It's just because somebody might take 2 decimal, somebody might take 3 decimal. See, if you remember 1.215 thereafter it was 7. So I have taken 215, somebody would have taken 216. So that is the reason why it may not tally. So, but a very close figure will work. 11,048, 050, 045, all these are possible. So what we did, we did annuity. Annuity is basically a series of payment of fixed amount, or it's a stream of equal cash flows. So the amount remains same. The amount 2,000 rupees. This is an annuity example, and we have solved this using a mathematical way, as well as we have solved it in a tabular format. So this, from the point of view of the chapter concept of valuation, if you remember, we discussed in the first video of this particular chapter, concept of valuation. We said concept of valuation, there are two techniques. If you remember, if you have gone through the first video, you'll remember that concept of valuation, we said there are two techniques. And we classified those two techniques as, one is compounding, and another one is discounting. If you refer, you will get this. One is compounding value concept, another was discounting or present value concept. We have more or less completed discussing the compounding part, which we have classified it under 3 videos. I will request students, viewers, to go through video 1 and video 2 also, to get a better understanding of this particular concept. In the next part of the concept of valuation, I mean to say the video 4, we'll start on with a discussion on the discounting of the present value concept. Thank you. Have a good day.